Look, in just a few weeks, the global stock market is going to get hit by what I can really only describe as a seismic event. We're talking about the largest initial public offering in human history. SpaceX is gearing up to go public, and they're doing it with a target valuation that, honestly, it's just hard to even wrap your head around. A $1.75 trillion asking price. But right behind all those awe-inspiring rocket launches and the cinematic dream of colonizing Mars, there is a seriously complex, almost mysterious financial puzzle just waiting for everyday investors. So in this explainer, we're going to peel back the layers of this historic offering. To actually put that staggering $1.75 trillion valuation into perspective, you kind of have to look at the absolute giants of our modern economy. Because at this price tag, SpaceX would be worth more than Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. Just imagine the sheer economic footprint of all those massive, everyday global brands piled onto one side of a scale, right? And then SpaceX all by itself, completely outweighing them on the other. It is an astronomical number. It literally demands your attention from the jump.
But here is where the story takes a really dramatic turn. Because despite that record-shattering price tag, if you actually look at the consolidated company of SpaceX last year, they didn't even make a profit. Actually, it's worse than that. They lost nearly $5 billion. And honestly, this brilliantly illustrates the central contradiction of this whole IPO. We've got a company asking to be the most valuable public debut in human history while simultaneously burning billions of dollars behind closed doors. So, the totally natural question you've got to be asking yourself right now is, who in their right mind is buying an unprofitable company at the absolute highest valuation in stock market history? Well, the answer might actually shock you, because the answer is you. Whether you live in New York, London, Sydney, Mumbai, it doesn't matter. If you have a 401k, a pension fund, or really just any money sitting in a standard tech index fund, you are about to become one of the biggest forced buyers of SpaceX stock. To understand how that's even legally possible, we need to look at what exactly you're buying. Section 1. Under the hood, the three faces of SpaceX. Let's look past the public myth and get straight to the financial reality. Because the actual revenue breakdown, it completely flips all our assumptions. The rockets, the part of the business launching NASA cargo and US government satellites, they generated about $4 billion last year. That's only a fraction, roughly 25% of their total revenue. The real financial engine here, the absolute crown jewel, is Starlink. This incredibly profitable satellite internet provider has over 10 million active global subscribers, brought in over $11 billion last year, and boasts rapidly expanding profit margins. Listen, if Starlink were its own standalone company, Wall Street would be absolutely obsessed with it. But then we look at that third slice, the one bringing in literally $0, and that third slice represents the ugly face of this consolidated company. Just a few months ago, SpaceX acquired Elon Musk's artificial intelligence lab xAI. Because, nothing says space exploration quite like a massive, all-stock AI deal valued at an eye-watering $250 billion. So now, embedded deep inside this rocket and satellite company is a massive artificial intelligence startup. And here's the severe financial drag that xAI places on the whole operation. It basically acts as dead weight. Right now, xAI burns through roughly $1 billion a month. Plus, earlier this year, nearly all of its original heavyweight co-founders just walked out, which essentially forced the entire division to rebuild completely from scratch. So when you're buying SpaceX, you're buying a highly profitable internet provider, changed to a decently performing rocket business, carrying the massive burden of an AI company that burns cash faster than a rocket burns fuel. Which brings us to Section 2, Defying Financial Gravity. Because guys, the math here simply does not add up. To really make sense of this, we need to use a tool that financial analysts rely on every single day. It's called the price to sales, or P/S ratio. This is just a fundamental valuation metric that compares a company's total stock price to its actual revenues. It's essentially the perfect way for us to measure, completely objectively, if a stock is dangerously expensive compared to the actual cash it brings in the door. So let's look at the multiples. A normal, healthy company in the S&P 500 usually trades at about 3 times its sales. Even a hyper-growth, futuristic tech giant like Tesla trades around 17 times its sales. Now consider NVIDIA, the undisputed king of the entire AI boom. At the absolute peak of its hype bubble, it hit a multiple of 45x. And yet, Towering over all of them, defying all financial gravity, is the SpaceX IPO asking price, an unbelievable 94 times its sales. It completely dwarfs the biggest tech bubbles we have ever seen. And independent analysts, they know this. Morningstar recently calculated SpaceX's actual fair value based on realistic future cash flows, and they priced it at around $780 billion. That means if you're buying SpaceX at the IPO price, you are paying a massive 114% markup. You aren't buying mathematical fundamentals at that price. You're paying a massive premium entirely built on the belief in Elon Musk's vision to dominate AI and colonize Mars. But if the analysts know it's mathematically overvalued, how can they possibly pull this off?
Section 3. The Trap: Hacking the Financial System.
This is where the narrative shifts from an overpriced tech company to systemic, rigged financial engineering. Because to make an IPO of this magnitude work, the rules literally had to change. The stock exchange actually quietly amended its own rules just ahead of this massive public offering. Before May 1st, we had strict price discovery rules in place to protect the market. But right on May 1st, NASDAQ introduced something called the Fast Entry Rule, perfectly setting the stage for the upcoming SpaceX IPO launch.
Let's compare these rules side by side, because this right here is exactly how the free market's ability to decide fair value is stripped away. Usually, a newly public company has to wait a full 3 months before it can be added to major indexes like the NASDAQ 100. And that waiting period is crucial. It allows the free market to trade the stock and discover its actual true value. Well, the new fast entry rule aggressively compresses that wait time down to just 15 days. Furthermore, they completely scrap the rule requiring a minimum 10% of shares to be available to the public, which is convenient since SpaceX is targeting a tiny public float of just 4 to 5%.
So why do those two abrupt rule changes actually matter to you? Because of this number, $600 billion. That is the sheer scale of the passive investment funds, the ETFs and retirement accounts that track these major indexes. When a stock gets added to the index, these funds don't get to sit around and debate the price or look at the price-to-sales ratio. They're legally forced by their own mandates to buy the stock. Period.
Let's just walk step by step through the mechanics of how this trap snaps shut. Step 1. The supply of shares is artificially restricted to a tiny 4% float. Step 2. The fast entry rule forces massive index funds to buy into the stock in just 15 days, way before the market can correct the price. Step 3. When you have massive forced demand trying to squeeze into a tiny restricted supply, the price artificially skyrockets. And finally, Step 4. Early private investors and insiders sitting on cheap shares get to sell at these peak inflated prices. And who are they selling to? They are using the passive ETFs sitting right inside your everyday retirement account as their guaranteed exit liquidity.
Which brings us to Section 4, the end of passive investing. The real question here is, has our safest wealth building strategy been weaponized?
The simple reality is this: you need to check your exposure. Because if you hold broad tech ETFs or standard index funds, the financial rules have been completely bent to ensure that you will own a piece of SpaceX, whether it makes financial sense or not. Wall Street has figured out how to take the exact vehicle that makes investing easy and safe for everyday people and use it to guarantee buyers for a heavily overvalued, unprofitable company. Look, SpaceX is an undeniable engineering marvel, but a great product does not automatically make a mathematically sound investment. So, I want to leave you with this lingering, provocative thought. As this historic $1.75 trillion IPO fast approaches and your retirement funds prepare to blindly buy in, are you really investing in the future of humanity, or are you simply providing a billionaire's exit strategy? I'd love to know what you think. Is this a genius strategic move to fund our leap into the cosmos, or is it literally the biggest retail trap in financial history? If you want to keep unraveling the mysteries of how the global economy actually works beneath the surface, make sure to follow us for more. Thanks for joining me for this explainer, and I'll catch you in the next one.